Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you get a good time. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Welcome to the day after the FOMC. It's a new world, apparently. A new world with higher interest rates. But how did we actually do? Well, let's go and look over here at the charts. Well, S&P 500, after taking a huge bender of a down move, I can zoom out here a little bit. You can see it. They really didn't like it at first, and then everything is awesome, and so we're up higher, and we've been handling things pretty well overnight. I don't see a whole lot of interesting news out there. Negotiations are ongoing. I don't see any developments on that side. Do see, so we come over to the treasuries. I'm still seeing a pretty decent amount of volatility, but we're also a little bit higher. Now, I think that going forward here today and tomorrow, the big thing is going to be the gamma and the options. And because there was so much, I mean, especially in the equity indexes, they were so bearish. And I think that that's what's been leading to this rally that we've had this week. And so I would expect there's probably some degree of that over here in the treasuries as well. And so the bias is probably going to be a little bit of mean reversion, but we'll see what we get. We do have news in 5 minutes, right? So we've got like jobless claims and so forth. So oil actually seeing a little bit of a pop here again, back to 100. So after chopping around there for a few days, I'm not seeing anything. Let me come in here, double check here. OECD says central bank should be prepared to intervene if needed to ensure smooth functioning. No, that's not what I'm looking for. Commodities. I think that that might have been that market realizing that the peace deal probably that they were talking about yesterday probably isn't going to happen, but I'm not so sure. Anyways, gold and silver kind of jumping up as well here. So, all right. And then we come over to the Bitcoins. The Bitcoin's trying to do many things, but not really going much of anywhere. It's kind of interesting on that front. And then, of course, the dollar. The dollar. Oh, why do I have it like? Why is it like that? The dollar's usually a lot bigger. Right? The dollar getting a lot weaker after that FOMC. So, but that is, I think, a lot of the risk premium coming out of the market. So that's essentially where we're at today. And we do have some news here. We not only do we get a U.S. initial jobless claims, but we also get the Philly Fed Business Index, which tends to be a fairly significant number. Oh, let's see. We also later today we got industrial capacity utilization. So yeah, we got a decent. Oh, we also get the housing starts numbers. So we are going to have some stuff to trade off of here today. I'm not so sure though. I don't know. Things are going to be really interesting today and tomorrow, but probably going to be more options driven. I have to say, I'm seeing some fishy stuff in options. I was kind of taking a look at options yesterday before the FOMC, and especially these small caps. So if you can go and find a small cap that hasn't had a lot of interest, like don't go and find a meme stock. Just go and find a small cap that's a really good small cap, but has been unfairly hammered from this downturn that we've had, right? Just the downturn in the small caps in general, right? And look at their options, and I think you find some interesting opportunities because there are a lot of these names that are saying like, "Oh, we'll only move $1," and it's on average moves $1 every day. So there might be some potential misprice. I wouldn't try and play this Friday's option expiration, but there might be some opportunities over there. All right. As for me, well, I have to say, like, the treasuries have only been open for 10 minutes, and look at how wide of a range we've already traded. So the treasuries appear to be still unusually volatile. But this may actually be good for us. We want to take we might be able to get some good trades here if we can find something that will effectively predict the order flows, which at the moment I'm not so sure that I have in my hands. Well, other than the options gamma. So we'll see. We'll see. From the Kremlin, Russia's withdrawals from the Council of Europe no longer considers itself bound by its legal acts. Okay. Biden will speak with Xi Jinping this Friday about Russia. Oh, that's a really interesting question. Mr. Top Step retweets this guy's got summary. He says, if it's 33 minutes before the closing bell and the SPX cashes down 792 points at 3608, and we are thus 88 points away from level 3 trading halt. If the SPX 3520 prints do closing auctions, so if they're close enough to the limit halts, do they still do the closing auction? I think that they would, but that would be weird. M Treasury's getting hammered here a little bit, but I don't know. Okay, so that was the news. What do we got? Philly Fed was 27.4 versus 15 expected. That's really good. That's really good. I don't have my news clock on. And what about initial jobless claims? 214K versus 220K. And the housing starts actually a little bit above expectations, 1.769 versus 1.7.
Looking to the markets now, just seeing some slight
building permits. Okay, so the housing numbers roughly in line, but the and the initial jobless claims, but the Philly Fed number really good, and that's probably responsible for that 4-tick downturn that we got there in the treasuries.
February outlook.
It's like kind of, we're getting some signs here today and yesterday, I would say, that maybe the economy is heating back up and concerns about interest rates are very much warranted. Well, okay, so they came back there really quickly. I still just do not like the liquidity that we're getting in the treasuries. It's pretty nasty. Oh, by the way, I don't think I said hi to Oceanic. Hi, how are you doing? Good morning. It's a little weird to come in and see the Treasury having been more volatile than the ES, moved more than the ES. But, okay, whatever. Move Bitcoin over here. I'm kind of I see maybe some weakness coming into Bitcoin, but it has had a hard time moving lately. Is there any way for the large players to see stop loss levels besides them, assuming that those stops exist at some general mechanical levels, such as previous settles, openings, etc.? By looking at the DOM, for example. Okay, so at the CME, there is no way for you to see other people's stops. No.
And the US
Not
housing
to my
for
knowledge.
February 2022.
I have often heard people claim, I've often heard random retail traders come in that in almost every case seem to have no clue what they're talking about. They're usually kids. I got to tell you, something that I'm seeing a lot more often is people that I'm pretty sure from the way that they talk and behave that they're like 14. You know, so I've seen some kids come in and make claims to that effect. But you can go and you can search through all of the CME's documentation. To my knowledge, there is no way to see resting stop orders. There is a way to see when a stop order has been executed. If you have market by order data, there's a way of sorting the data out that will tell you that that market order was triggered by a stop. That is possible. So it's feasible that we could do an empirical study surrounding where stops are most likely to occur. But I suspect, man, this is just a little bit of unusual volatility here. Like it moved, it kind of quieted down after Philly, and now it's kind of flipping around all over the place again. I am seeing some heavy sell pressure in the 6J, so that might be some correlations coming in here.
So in 10 minutes time at 8:55 a.m. Eastern time,
the micro treasuries are not giving you very good prices.
Participating in the monetary policy debate at the ECB and its Watchers Conference in Frankfurt.
So we'll see.
Indication of text or Q&A from ECB.
Anyways, the fact that I haven't seen like a real study about this kind of suggests to me that there are a lot of stops everywhere and that it's actually quite random. But that's just a guess. I would have to really look at the data, you know?
It says that the Russia and Ukraine conflict will weigh on economic activity in most G20 economies, although the impact will vary.
But I think that the other problem is that stop orders would not be very predictive of future order flows, right? If you can identify a location, think of it this way. If we can identify, let's just say that we know that a break of a previous swing high, swing low results in more stop orders, right? Then we might be able to make the assertion that we have a risk reward ratio in our favor, because if they break that swing, there's going to be some orders and it's going to take it further, right? But how do we know that it's actually even going to go to that spot to begin with? And so without a predictor that tells us that it's going to go into that location, that information is not actually that useful. Does that make sense? And then what is really the useful thing? The thing that tells us what direction is going to go, and not necessarily the thing that's going to tell us the stops. Because guess what? There's swing lows and swing highs. There's both directions, right? So does that really actually give you a positive expectancy? I'm not so sure it does. But that's just me. Now, in cryptocurrencies, it's a very different story, right? Cryptocurrencies, the exchanges give insiders information about where stop orders are placed, and they go and they gun for them 100%. This is a pretty thoroughly documented phenomenon. So in Bitcoin, yeah, you gotta be careful. But here's another thing is I would trade with the assumption that the market is going to come after you. Like the robots, they can see every order, right? Okay. So your order is factored in, and they are going to adjust their strategy based on every order that's coming in to give them the best advantage over you. And the market maker would not be making the price that it is unless they thought that they were going to make money from it, right? So the prices that they're giving you are always going to be to your disadvantage. So if you're going to take a trade in that kind of a situation, what do you really need to have to take a trade, right? It really kind of puts things in perspective that this whole idea of like, well, based on the past action of the market, I have like a 1% higher chance that X is going to happen instead of Y. Okay. But when you start to factor in the spread and everything else like that, really makes that kind of trade sound silly, doesn't it? Right. You really shouldn't be trading unless you really have a solid reason to think that uh, you're really going to predict the order flow, that you really know which way it's going to go. Which is why, even though we kind of got a lot going on here, I'm a little bit hesitant to try and do something here. I'm not actually seeing very strong flows come in. The order flow, in fact, the market orders appear to be long at the moment. And I think the reason that we're falling has more to do with the 6J. So that has me a little bit, it has me a little bit wishy-washy because on one hand, that Philly Fed number sounds awfully nice. That kind of sounds to me like something that could make rates rise. But we're not really, when we fell, it was because of the 6J. I'm not really seeing the volume come in, and there's still kind of this mean reversion thing going on. So I'm kind of think we're in a situation where just me watching the cumulative delta could give me like really bad signals.
Comments from ECB Schnabel participating in a monetary policy debate at the ECB and its Watchers conference in Frankfurt. Again, no indication of text or Q&A from ECB Schnabel in just under 5 minutes time now.
Global stock closed up or 41.7% this Chinese index on Wednesday. The Chinese government said it would support foreign listings. Nearly all U.S. listed Chinese stock exploded higher. Interesting. Another thing is the way that this is moving is kind of a little weird. The way that the micro yields are moving compared to the treasury, like this treasury moves maybe 2 ticks and this is moving like 7. So maybe there is a little bit more movement on the 30-year end of the curve or something. It does look like we're getting a little bit of steepening. So meaning that as we've been moving down, that 30 has been going higher. Or been going faster. Not on that move, though. That move, it was the 10. Maybe there's some flattening coming in. I don't know. I think that when I said, the market maker, he's been nice to me lately. He must be a viewer or something. And maybe when I said, well, I think that I'd just be getting fake signals and everything, he said, okay, fine, let's just go without him then. You do that. You go without me. Because I'm still not sold on this. Satellite shows scale of Ukraine destruction. Says Reuters video. It's not a war. It's the destruction of Ukraine. Oh boy. Let's watch this. Okay, so now they're showing us old satellite images. And now they're showing us today. Yeah, that's crazy. Okay, the treasuries it looks like they made 1 tick lower low there. Still kind of looks like they're just gonna push through. Man, there really is like those areas are just demolished. Most of the time, I assume that stops hover around tension levels, chop levels for either longs or shorts level, which dictate uncertainty based on the order flow at least, but also on the time factor. Yeah, I don't know. I mean, I'm sure that there are a lot of retail traders that place their stops around those levels, but I'm not really sure that it's going to be significant enough to make a difference, really. You know? Like the thing that I've found when doing my back testing is that the volatility is such that it will always exceed your average volatility. Does that make sense? It's like you see that the swings we're having right now are like 4 to 8 ticks or whatever. But then there's this one swing that's 11. So it's like it will be kind of range bound, you know? Everybody will get in saying, here's the range, and this is, it would be unusual for it to go outside of this range. And then you're going to have a move that goes outside of that range to the one side and outside of that range to the other side. And then maybe it actually goes the way that it's truly going to go, right? Like it's really just and why is that? Because markets are inelastic, right? Prices are inelastic. So the orders are always going to move it further than it should. They are always going to move it further than the retail trader expects, rather. Right? So the whole... Octavia says you're right. Well, I think you guys all understand this intuitively, but I'm trying to give you like a scientific reason for why this happens, right? Orders have large impact. So that means that prices are not very elastic. When price rises, it does not decrease demand very much. When price lowers, it does not lower demand very much, and vice versa for supply. Supply and demand basically aren't affected by prices moving very much in a limit order book functioning market, right?
Seeing comments from ECB Schnabel saying upward price pressures to prevail over the near term.
So this whole idea of coming in and saying, here's a support line, I'm going to try and buy it as close to that line as possible and have my stop down here below this line, and that whole idea, just based on how the market tends to move, is doomed to fail. That whole kind of setup. And then you add on top of that you really have no real edge in trying to say we're going to move up or down based off of that we just moved up or down.
Counterparties can mobilize as collateral at any moment.
So you add those two things on top of each other, and retail trading strategies are just doomed to fail.
Energy price inflation.
On the split side, though, if you actually have
of our bond portfolio,
my voice is cracking,
unchanged, or when we start to reduce.
I don't know why I feel maybe a little bit more tense than I should this morning. Anyways, the split side of that is that if you are trading off of an order flow driven theory of markets, and you really truly have something that is going to be effective at predicting the future flows, and it's going to be a strong flow, then you really have things on your side, right? Because you're going to be able to take a trade. You shouldn't take very much heat. You're going to be able to get like a really, really strong risk reward ratio on there and a high win percentage. You get what I mean? Like if you truly have a strong predictor of order flow that you can trade off of, you can potentially get high win rate and high risk reward. It's pretty cool, right?
Signs of a de-anchoring of medium to long-term inflation.
If you truly have a good piece of information, which
justify a more forceful
isn't all the time. I'm not really sure that we have that right now.
Effect of higher energy prices can be persistent.
You can kind of see how the treasury markets were really kind of pushing down onto the downside, and they didn't really get a whole lot there, did they? like that whole sequence really looks to me like probing for stops and not really getting much, then deciding to go the other way. Or another way of putting that is the behavior that I see right now looks like purely market maker activity. And in that kind of an environment, we don't have as much edge. If we are going to try and take a trade, we're probably going to want to take more of a mean reversion trade, right? Like in that situation, if we took a trade, the smart trade was probably long at 14 there in the ZN. Long at 14 and maybe if you're lucky get 17. Maybe if you're lucky.
ECB Schnabel says the EU's plan on Russian gas is likely to fan inflation. It's also worth noting
So I don't remember why I did it, but I followed Sputnik to try and get Ukraine headlines to see what the Russian propaganda was putting out. And it really is like everything that Twitter account puts out is trash trying to divide Americans. It's really obvious.
ECB Schnabel says the marked fall of fossil energy prices is rather unlikely.
And I'm still having a hard time. Like the thing is that if I want to go long interest rates here at 2.17, maybe if I got 16.5, that would be a little bit better. 2.17 seems like a fair place to try it. So I can definitely see kind of the edges in the order flow where I might want to try and take such a trade, but I just don't have something that makes me think that it's going to go one way or the other. And the way that the order flow is playing out right now just makes me less certain because the flow seems really wishy-washy to me. So maybe something that stays wishy-washy for a while and then eventually the traders, well, okay, so there was something right there. There was a big iceberg kind of hiding at 14 that got traded. 2K traded there. That had to be an exchange side iceberg. You're out for the day. Hey, thanks for stopping by. Yeah, that's going to move them up. Okay. If I come in here on ZN, I bet you I could grab one tick here and try it on the sim account. Well, I'm not particularly liking how it's going already. Like, he did it. Move it down. No, like see here, it's ticked down. No activity now. Okay, good tick back up. Hit me. Thank you. Hi, Brad. Do you have a video introduction of Dom trading? So I have a whole video series on Dom trading. If you visit my channel page. In fact, do I have? You know what? It's gotten to the point now where I have so much stuff that I don't even know where to even freaking begin. Yeah. I think that if you want to do the DOM training without here, I'll just go and find it for you. You know what? I should just add the first one into that. Order flow and DOM trading for beginners. Now I'm just going to add this into the start here list. I got like a 4-part series on this. So here's my first video about the DOM, essentially. I think there's probably a couple of other videos I need to make. I need to have like an introduction to futures trading. Like I have one, but I should make a new one. And I think in that new one, I should go a little bit more into how I trade. Because you gotta understand that watching the DOM is really more about what the current conditions are rather than seeing something that is going to tell me to go long or short here. Every once in a while they'll give you one.
Says that fiscal
every once in a while.
Is key in buffering.
I've found that it's pretty freaking hard to trade just off of that. We did have one there. Remember when I said at 14 there was a big they ran into a big iceberg there? That was kind of a key tell. It's like it's kind of quiet and all of a sudden this big order gets revealed. Yeah. Somebody's buying. The spread here in the 10-year is a little, and the 10-year micros is a little bit better. But remember, I said like the real trade is like 14, and if you're lucky, you get 17. Let's see. It was you, Uzi. I got you tipped everybody off. Well, I hope the long works out for you. Did you get everything you needed? Because I don't know if this is going to go any further or not. Yeah, I think an order like that probably persists for quite some time, but we may have seen most of that first leg.
Will be gradual.
So we'll see. We'll see. So many contracts.
ECB Schnabel says that normalization conditions on fallout of war on prices.
Balling at 2K a tick. I wish. Dude, if I, like that trade that I just did there where I took 1 tick, if I could make 2K doing that, man, you'd have it made. You'd have it made. Wait, what is 2K divided by 15 point? Blah, 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 blah. It's 65. Okay, 2,000. Oh, it should be. No. Yeah, 128 contracts. If I want to develop a profitable algorithmic bot, what should I focus and rely on? So if I was starting a market making robot, the first thing that I would look for is arbitrage. I got to tell you, man, you're going to be surprised when you really get into this in the literature that's out there, how complicated a program like that can get. But the first thing that you're going to be doing is you're going to be looking for some sort of an arbitrage. Something where two related instruments where you can arbitrage between the two of them if you needed to, right? To help you decide where to start your bid ask from. And then you're going to have to watch the order flow to kind of determine when you need to pull your prices.
Effective Fed's fund rate unchanged at 0.08% on March 16th.
Get Sharkin, no. They're not going to help you do that. Sorry. You could build such a thing in NinjaTrader, but to really be successful with it, you're probably going to have to eventually take it out and do it in C++.
Schnabel
maybe even have some parts that are assembly. Because you're going to have to be fast, right? You have to be fast. Because the thing is here, these guys, they have this, I'm just telling you, these are the things that are a part of, like the guys that's putting 400 contracts at every level or whatever. These are the sorts of things that he's looking for, right? Looks at correlated instrument. He looks at the order flow that's coming in to determine possibility of informed trading coming in and choosing to pull prices, right? And then you'll have all sorts of risk management stuff built on top of that. Okay. So now you've done all of that. Guess what? Your robot is only just as good as all of the other robots out there, right? So you've maybe only got just even if you discovered something really groundbreaking and like a new development in market making technique, right? You've only just built this teeny tiny little edge on them at that point, right? So what does that mean? You're going to have to be fast. You're going to have to be fast. And they have programs that are co-located on the exchange. So being able to do all of that processing that you need to do very, very quickly and do it at a co-located exchange is probably going to be necessary to really, truly be successful with that sort of thing.
ECB Schnabel saying we could actively tilt our portfolio.
I guess that's kind of more the market making approach, right? If you maybe not a high frequency trading route, but just like an algorithmically backed strategy, then what I would be looking for is predictors of order flow, which is what we do. But try and find predictors of order flow that you can see quantitatively, right? Because a lot of the predictors of order flow that I look for are a little bit more fuzzy and qualitative, right? I'm trading more like changes in people's perceptions and that sort of a thing. But you could probably build a robot that says, here is what the positionings appear to be based on what options have traded. And as such, I want to buy going into options expiration and yada, yada, yada. Like you could maybe write something that does that. Right. And I would go and read scientific papers on trading. Yeah, those always give you really good places to start. Probably not enough to be profitable on your own, because everybody has that stuff. But it really gives you a good base to start your research from. And yeah, it's a long road, I gotta tell you. Algorithmic trading is really harder in the end. All that needs excellent programming skills, probably, yeah. If you're not a computer scientist or an expert in statistics, there's probably more effective ways for you to make money, right? That's why I kind of haven't been doing so much programming anymore, because the programming that I do is really good at disproving technical analysis strategies, but not so good at high frequency trading per se. Actually, no, I think I could make a high frequency trading robot. It would just be a lot of time. So I need to become the expert in statistics. So I've kind of taken a step back, and I'm doing a lot of research around the statistics now. I guess one place that I have been doing a little bit of research lately and has some efficacy is cycle indicators, right? Cycles on short time frames are definitely a thing that can give you a tiny edge. Or at least a slightly better position. Where can I get the documents? Go to archive, arxiv.org. I'm having problems sleeping. Dude, okay, if you're here, I won't give you the French guy's book. Let me give you something else if you're having trouble sleeping.
In 10 minutes time at 9:15 a.m. Eastern Time, we receive the US industrial production month-on-month data, forecast 0.5% on the prior 1.4%.
Okay,
while
here
the
we go.
range is seen at 2% to minus 0.2%. Also have the US
If you're having trouble sleeping,
forecast
read that.
on the prior.
That's the statistical consequences of Fat Tales by Nassim Taleb.
Forecast
You know, he has his Inserto series, which is really intended to be a collection of books to be the basis of like a new school of study of studying the science around statistics and so forth, right? And the books that you've all heard about, like Black Swans and Anti-Fragility and things like that, those are books that are like geared towards a general audience to some extent. That book, the technical Inserto, is written for people that are basically already experts on statistics and is trying to explain all of the fallacies in the statistical world as it's practiced today. So I think you're probably, that's a book that if you're going to read it, you're going to go in and you're going to read stuff. You're going to be like, what? So like, for instance, I was reading it last night and he would say, okay, so here's this formula and the first movement is going to be this and the second movement is going to be this and the third movement is this. And I'm like, what the hell is he talking about, these movements and stuff, and how do you get them? Well, apparently what it is when you run I don't even know how you find the movements. It has something to do with like you take the sum over the integration of it, and then you get the movement. But basically, the second movement is variance, and the third movement is skewness, and the fourth movement is kurtosis, essentially, right? So it's like there's going to be a ton of stuff in there that you're not going to know anything about. You're going to have to look up, right? But it'll put you to sleep. It'll put you to sleep real well. Real well. Jean-Philippe's book, too, at points gets super technical and could put you to sleep. But there's some parts of that book that I just find so riveting. Chapter 20 is just, man. I got to tell you, man, once you understand, because here's the thing with Jean-Philippe's book. I wouldn't expect you reading through it to be able to derive all of the equations that are in it. I can't do that. I want to get myself to a point where I can do that, but I don't understand all of the math behind it per se. some of the more simple ones, and then I explain that stuff to you guys. But some of the more complicated ones, I don't understand the math behind that. Hawk's processes, that's hard. Hawk's processes, that's complicated stuff. But he does a really good job at, listing down what are the consequences of that and everything. So once you understand the mathematics behind why the market moves the way that it does, then you take it back out to like what we would call a mesoscale. And all of a sudden, it's like all of these questions that everybody argues about are so clear. It really is like a ding, oh, everything makes sense kind of thing. It was like I was saying in the video that I made about it. It's like that moment in the Matrix where Neo all of a sudden can see the Matrix. It's seriously like that. All the things that confuses everybody else are very easily explained once you understand the real statistical behaviors of markets. And in particular, that markets are more statistically efficient than they are informationally efficient, and that orders move price. So I was thinking about this the other day. A big one that you hear a lot. Don't listen to economists. If they were any good at their job, they would be traders. Well, no, that's not true, because an economist's job is to predict the economy, not the stock market. And what moves the stock market? Orders. What moves the economy? It's a completely different set of things. And you can come in and make very effective predictions of the economy and still not be able to know where the stock market is going to go, because you have to know how the orders are going to react to that information.
We also have the US capacity utilization, forecast 77.9% on the prior 77.6%. US
and now you understand why does Wall Street pay so much for all of this research if it's supposedly no good?
With a prior read of 4.08%.
Oh, I need to turn that off. You shouldn't be able to hear that. And why do they spend so much money on it? Because it's useful. It's just they have to take that information and digest it to see how will the orders react. For his book, though, here's Jean-Philippe's book. If I was starting, well, I don't know, maybe there's a place in the world that they do this, but if I was like head trader at a bank, or I was starting a hedge fund and I was teaching traders from the ground up how to trade and execute, I would basically treat it as a college course with that book as the textbook. That's what I would do. Because once I read that book, I understood, oh, that's what the traders at Goldman were talking about. I didn't learn it from Goldman. I knew just enough to realize that that's what they were doing, but I didn't learn it from Goldman. I learned it. Otherwise, I probably wouldn't be telling you about it. Right? I'm really in kind of a unique position. Maybe the only person in the world. Maybe that's why I'm the only person in the retail trading space that tells you guys this stuff, right? Because I was close enough to the trading to kind of see what was going on, but not so close that I wouldn't be talking to you about it or have the opportunity to talk to you about it, right? Because most of these people that they're retail they're traders, they stay there. They keep trading there. So then you definitely never talk to them, right? You come back, you're not going to really understand the retail trading mentality, so you're not even going to know what to say, right? So I'm realize this is why I keep saying this. Like I really have realized I am in a unique position. I really truly am. But there's another factor that makes this unique, and that is that it is not what people will believe on their own. Does that make sense? Like if you were to just come in and I said, okay, this is what a market is and this is how it behaves. And then you just kind of said in your head, okay, this is how I think that market should behave. You would never get the answer that the math says. Which is why it's really important that it's empirical research and that they don't just come up with a math model, but then they show how effective it is at explaining the market. You know, how well does it match up with the actual market data? And it turns out that they match up incredibly well with the actual market data. Okay. It's unintuitive. It's unintuitive. Because the way that the human brain works is watch thing, find pattern. And it really wants it to be like a straight thing. Frankly, the whole idea of like you take a trade and you're going to win more than you lose, but you're not always going to win, that alone is a hard thing. You know, so there's this game called Stardew Valley. Any played Stardew Valley? I tell you what, maybe if we're having a really shit market again, okay, like they close the exchange down. If they ever close the exchange down, we'll play Stardew Valley in Minecraft, okay? In Stardew Valley, there are festivals at the end of every season. And at the end of the spring season, I think it is, there is a festival where there's this game of chance. And in this game of chance, it just says, how much do you want to bet? And then do you want to bet on green or orange? Is what they says. Right? And that's it. Well, unbeknownst to you, there is a 55% chance that it will be green. That's the game. So if you come in and you just bet green every time, you will eventually win. But, you know, it kind of also depends on you sizing. So if you come in and you use the Kelly criterion to size your trades, then you can size up and beat that particular game the fastest. Right? Kelly criterion. But most people, even if you tell them just pick orange every time, most people will pick green a few times, and it takes a little bit for them to convince themselves that it's actually the case, right? So just that in and of itself is like not the way that humans typically behave, right? But then when we come into the markets, we have to come in and we're saying, oh, well, actually, the patterns that you see, you're just watching the price and you see the patterns, all of those get arbitraged away by people trading it. Market is statistically efficient. That is not the way the humans operate at all, right? So then you come in, and so then they say, okay, this doesn't work. Technical analysis doesn't work. What am I going to do? I'm going to use fundamental analysis. Look at the fundamentals, determine what the intrinsic price of the asset should be, and trade based off of whether we're above or below the intrinsic value of the asset, right? Well, that doesn't work either, because guess what? Markets are not informationally efficient, right? So what do you actually have to do? You have to watch the orders. And this is why I think that a lot of people say just watch the order book for a really, really long time and eventually you figure it out. I think the thing that you're intended to figure out is that it's the orders that move the markets, and that the orders can completely contradict what they're supposed to be doing. Right? We got to find things that actually predict. We got to find things that actually predict what the orders are going to do, which is hard, but I think that they do exist. Certainly changes in perceptions about fundamentals or future order flows definitely affects the markets, and there are times when you can make pretty good assessments of what the changes are and be one of the first to trade and make money. You can. Can you do that consistently? I don't know. You got to be really good. You gotta be really good. But now all of a sudden it also becomes clear why most retail traders lose, but the very few that make it to the top are incredibly successful, right? Because it's a hard thing to do, but if you're able to do it, your effectiveness is just insane. Because again, what you can get high risk reward and high probability. Boom. Right? That's what I would, if I was teaching people to be professional traders, that's how I teach them. So the financial juice guys have not turned their microphone down all of the way, and I can kind of hear them, and they're having a conversation right now. And I can't hear what they're saying, but they sound really animated. So I'm not familiar with the person that you're talking about, but I think that's probably somebody from social media. Something that I've found is that there's like a trillion guys on Twitter and TikTok and everything saying just follow Congress and their trades. Well, it's one thing. This is one of the things that I think is really funny is whenever you look at like a quantitative analysis of that, what they do is they come in and they say, yeah, these congressmen, they're really effective traders. Why? Because they know things that predict future order flow, guys. Okay, but does finding out the moment that a congressperson, you find out that they have a position or that they bought something, when it comes out in the reports, okay? At that moment, does that predict future order flow? Haven't seen that one. Like, here's the thing. Would you rather follow Nancy Pelosi or would you just rather know what Nancy Pelosi knows? Yeah? Just saying. Can you find things that are like the things that Nancy Pelosi knows? Yeah, you can, actually. You really dig deep. You're probably going to have to dig, it's probably going to have to be things that aren't just like what you find from a Google search, though, right? Like, you ever watched Wall Street Money Never Sleeps? And what did they do? They found out that this guy was in town, and so they followed him around town until he left, and then they found out where that plane was going, and that's how they determined what he was doing. Right? You can find that stuff on the internet. But the trade that they did from that guy, as far as I understand, well, they might have done some other things in there, but seeing a plane flight going somewhere, and you can trade it. Yeah, you can legally trade off of that, right? That's not insider trading. Boom. Can be done. I guess the key here is we need to make some friends with some congressmen, huh? Well, so the treasuries did finally get above 17. There was quite a bit of a pullback and wrangling around before they did it. And now that we're back up here, we're kind of ranging in this area. So I'm not sure if they're going to come back up to the high of the day and bust through that, but it's entirely possible. I must say, it's entirely possible. And there does appear to be some degree of a meta order buying through in this location, but there's also, some mean reversion in the 6J. And overall, the S&P 500 has not moved very much at all. We got about 7 minutes until the S&P 500 opens. And maybe it is just that we've been so spoiled with volatility lately, but this is an awfully quiet market, man. It was an awfully quiet market, isn't it? It's like it wasn't worth trading because there was too much going on, and now not sure it's worth trading because, well, we're getting enough movement to make money off of here, but I don't know if we actually have a real good predictor, fortunately. I was kind of leaning long, I suppose. Both because of the gamma and then because of the big block order that we saw down at 14, but not confident enough on that to trade it. And you know what? If I had traded it, maybe would have made $10, which is not all that spectacular. $10 pre-standard. $20 is like, okay, yeah, that was a good move. That was worth trading. You know? Leader McConnell, President Biden needs to step up his game on aid for Ukraine. The resistance needs more lethal weapon systems that go after not only helicopters, but higher flying planes. We ought to be facilitating this aid right now. You notice Congress really kind of pulling Biden around on this sort of a thing. I think this is an interesting strategy by Republicans to try and make Biden look weak. But China's market regulator says to focus on boosting market expectations and confidence help to unblock domestic circulation. Okay. I do have to wonder now that the FOMC is over and all of that. Yeah, are we going to see a situation where the Ukraine war comes back into the spotlight? Seems like a likely scenario. You know what? I feel like I haven't been doing very good with making a ton of content for the channel last 2 weeks or so, but I've been getting a lot of subscribers. It seems like it was only, it was like the beginning of the year that we were at 7,000 subscribers, and we're already at 7,400. Which is great. Like the organic growth is pretty crazy. A channel's never like blown up, but that could still happen. That could still happen. They come in here. What videos are they watching? Well, Mud is the best futures trading software platform. Still tends to do really good. It's funny. My older videos. Why technical analysis fails? My newer one. That's doing all right. Still, it's weird to me. On the views, it's towards the lower end of the range. Part of that is I think that the most recent videos that I had, the order flow series, did really, really well. So this one is kind of this is just off of the last like 8 videos or whatever. It's towards the bottom. But really, this is kind of more like average performance for a video. But I don't know. But when you come into reach, nobody's searching for it. Nobody's searching for it. But the click-through rate is okay. If we get above 5% click-through rate, that's good. That's good. Man, my lips are really chapped today, and I feel like I've been drinking a lot of water, but it's not going away. The action in oil this morning is very interesting. I'm not sure I see why oil has been surging today. It could just be a technical thing, but Sterling tumbles after 25 basis point rate hike by Bank of England. Futures drift lower after Kremlin dashes Ukraine peace hopes, curve inversion persists. Well, there's been a little bit of steepening this morning, though. I think that the zero hedges, I got to tell you guys, something that really, really grinds my gears is there's a group of people. Zero hedge is like at the top of the list, but there's like a bunch of analysts that are popular amongst retail traders and so on and so forth. And their shtick is basically the Federal Reserve sucks, and they're always criticizing everything that they do. And so before, the criticism was the Federal Reserve's not going to raise rates. They're never going to do it. Okay. They were wrong. Federal Reserve did raise rates. So now the thing is, well, the Federal Reserve is not raising rates fast enough, and they're going to create a recession. Well, I agree that they didn't raise rates fast enough, but kind of have hindsight to see that. I would have done it faster. I would have ignored the Omicron variant and raised rates anyways. But I could see why they'd be cautious, right? I can see why they'd be cautious. But recession guaranteed? I think I trust Goldman Sachs, who says 35% chance of recession, more than I do these other guys, because these other guys have basically been wrong every step of the way for the past 6 months. And I'm not convinced that this yield curve inversion is signaling a mistake by the Federal Reserve per se. I don't think that we know everything about the yield curve and inversion and why it does the things that we do. We could well come into a situation where the yield curve inverts briefly multiple times and over the course of multiple years before there's actually like a recession. Just saying. Especially with how flat the yield curve has just been for such a long time. Man, even the open of the S&P 500 is pretty slow there today, guys. You all burned out? You don't want to trade today? Is that what the deal here is? Yeah, we're pretty low on viewers today, too. Normally, we're more like 20 to 30 viewers, but we're only at 15 right now at the market open. That's pretty low. I think we should stick around, though. Something could happen. I think there's a really high possibility that we get some sort of a news headline or something really shuffles things up happens. So let's just hold tight and be patient. I suppose this would be a good opportunity for me to try and practice being focused. I'm kind of that now that we're back to 2.175. Maybe a short there. Yeah. No, not there. It's a pretty big iceberg at 15. A little suspicious of it. There's a volume on both sides of it too. So at first it kind of looked like, oh hey, that buyer is maybe still there. We could buy here. Well, they did tick up, but I'm a little concerned about how that transpired because that could become a liquidity hole. That could very easily lead to a liquidity hole here, especially as the S&P 500 is not really doing anything. Now that they're above the open, I will take a sim trade here. Doesn't look like they ever really gave me a super good opportunity to take 17.5, but there you go. Okay, maybe I'm wrong. It looks like it was good for at least 5 ticks. Suppose if there's a hole there at 15 that you could still get maybe even as high as 17 before it could drag them back in, but the S&P 500 is looking pretty good so far. Not breaking though. Yeah, it's pretty wishy-washy volume in the ES too. It is pretty strong market buying, but it's not really going anywhere yet. So perhaps some of this risk premium coming back into the market. Looks like I definitely missed a trade in the treasury because it's coming down to what would have been my target anyways. Oops. Pushed the wrong button there. That's okay. Just cleared my center columns is all. Ooh, I like the way that turned. There was some good massive absorption down there at the lower end of that range, and they almost immediately bounced off of it. And Treasury seems to be reacting a little bit too. Good. Yeah, well, so John, the triple Witcher tomorrow is definitely an important event, and I do believe that a large degree of the bullish action that we've seen this week in the S&P 500 is because so many people took puts on this option expiration because of the Ukraine thing and are being forced to unwind them and or hedge for the gamma and all that sort of stuff. So I think that up until the expiration day, my bias here is buy the S&P 500, buy the treasuries. Um, but the order flow in the treasuries has not been confirming that trade. There has been some signs of a passive buyer, but the flow in the treasury has been really, really wishy-washy. The S&P 500 is looking a little bit better, but I have to say it's a lot harder than it has been, isn't it? So, I don't know. Just see how it goes. I took a sim along here. We'll see if we can get this one to ride. And you can see now the treasury's given me 2.175, but I'm a lot less interested in it now. Unless like the stock market falls apart here or something. Otherwise, it kind of looks like that treasury yields might go a little bit higher again. I could try buying 17 half and trying to get 18 half, but I'm not so sure about that one either. All in all, I see like there's a slight bear bias in the treasury, but overall, I don't really see any strong evidence of big meta orders or anything that I could use to really predict the future order flows. It just kind of looks like a mostly market making activity. And you might get some of that tomorrow. We might get pegged at some point. I'm going to bet that the key gamma level to look for is 4,400, but I don't know if we're going to get there before then. Yeah, look at that. Treasury comes right back down quite easily as the S&P 500 buys. I feel a little disappointed by the action in the treasuries today, but I kind of knew coming in that I didn't really have something. The day before, the day of, and the day after Triple Witcher, they're your biggest losing days in the past. I would work at it because I think that understanding what's going on there, you can get some good probability trades. Well, they broke some highs there. I am seeing some little slips lower, but it still looks like the buyers are in control. For me in the treasuries, this is where I kind of think still a good chance that in the next hour and 15 minutes we get a headline of some sort that could direct our trades. This trade in the E-mini has been pretty darn effective so far, hasn't it? Like we had a little bit of adverse excursion. How much was it? 28. Okay, so we've just had it go as much in our favor as it did go against us. So for this trade to really be worth it, I think we need to have another another leg higher. Oh, you have an algo that you turn off. Yeah. I would totally be trying to write something that uses the options data to try and predict which way it's going to go. I think you might be able to find some good strategies there. Or you could just read Zero Hedge when they stilled Charlie McElliott from Nomura's notes. Where does one go? Well, I don't know where I would get it from a data perspective. That'd be part of your research, is finding the good data. Go ask Gamma, what do they call it? Spot Gamma. Go ask Spot Gamma where they get their data from. Or maybe just use Spot Gamma. Okay, that's looking a lot better, a lot better. I'm wondering now, I think now after all of that, probably they're going to be eyeing the overnight highs, right? Up into the 4360 areas. One of the things is that data outside of futures, I've never had any reason, I've never gone and tried to build a system of that sort of a thing. So I don't really know what the data is. I've done a lot of research on it, but I haven't been able to really try them, except for the thing that I got for here, for behind me, the ticker that I did a bunch of research for that, and then in the end just ended up using Yahoo Finance. So okay, so there was a Ukraine headline there. I don't know if it was anything too significant, but the Ukraine foreign minister is speaking. I guess they're trying to set up a meeting between the presidents. Yeah, there's quite a bit of volatility there, but I think that what you're gonna see is options pressure is probably going to continue to be long, with intermittent spurts of risk off from Ukraine headlines anytime that something like that comes over the squawk. Don't think that one was enough. It does look like maybe we could have gotten the 18 half. Only 3 contracts went off there. Is that overnight gap? Nah, barely. This is kind of a situation. Gap's not that interesting to me. It's just like, okay, there was a really good push into the close. I think that there was a little bit of just like after effect, more orders coming in, pushing them up. I don't know if that overnight gap there is really all that big of a deal. And then, slide down. Actually, the difference between them is pretty insignificant. I'm much more interested in if we were to break the overnight high, which we tend to do, right? We tend to, more often than not, we will break the extended range high. But, and in this situation with the options, I think there's a pretty good chance that we can do that. But we're coming back. We're getting quite a bit of a pushback there. So, if I wait for the cycle here to complete, I might be able to buy it in here somewhere. I'm kind of wondering what I want to do in the treasuries, though. It looks to me like the treasuries are more taking their cues from the S&P 500, which probably means that you want to buy it, right? Or rather, buy yields. They kind of dug out of that really quickly. And then, of course, the treasuries move back to their lows. Treasury maybe backed off a little bit there, so maybe we're going to get another swing back to 15. We shall see. Problem here is that we could see a further climb in yields, but it might be a really steep pullback first. Because we just had a pretty decent move in the 30-year. We are getting steepening on all of this, so that kind of helps. Treasury's coming back down, or sorry, ES coming back down to that bottom end of that range. The cumulative delta, though, looks really, really clearly strong buy. Oh, there they go. They're breaking it. Breaking those lows in the treasury. Still nothing gone at 19. So I guess I'll call it 19, 2.19. Surprised there was no profit takers there. That's okay. Well, okay. 18.9. Sure. That 30-year is just crashing, man. Crashing hard. You think that the ES long's making the short? Well, yeah, I'm sure that there are a lot of people that with short options on here that are like have to hold it into the close because they're too big and are kind of sweating this, right? Like, how far back is this going to come on me? For sure, they're for sure thinking that. That 30-year is not. So in this situation, this might be a situation in the treasuries where we really want to pull back and they just don't give it. You know what I mean? Because it's really turning into a bubble down move. I didn't really necessarily see super strong volume pushing down through here either. It's kind of sliding, which is the way that really strong sell movements in the treasuries tend to go. Yeah, there'll probably be a bunch of stops above last night's close. Well, let's not say last night's close. Let's look. I really think. Oh well. So like right here, if we break another new high, there probably is going to be a decent number of flood of orders come through. You can see a little bit of that sort of stuff going there. Okay, what's this? Not hearing anything on the squawk, but that move kind of was suggesting news. Curious that the 5 and the 10 moved back there. The 30 is still chilling down at the lows. Yeah, get it. I really think I'm gonna hold one of my contracts in the ES until they break the overnight high, which is gonna be like 43.66. Hmm. So another 10 points in this rally, maybe. Hmm. Well, they were willing to hit me there, which is curious. Think that the movement that we're seeing here is still like 6J correlation. My lips are still really, really chapped, okay? Bear with me here. Is that the 300 SMA? Ah, you have a 300 SMA? Okay. Whatever. 200, I have a 50-10 and a 200 on my daily chart, but I gotta tell you, the market definitely will behave differently as to whether they're above or below the moving average. But using those moving averages as like entry and exit locations is like a really bad idea, I've discovered. Like this just goes back to markets are statistically efficient. So all of these areas that people think matter, like key levels, basically what it ends up doing is it creates more noise around those prices. The advancers versus decliners. So the tick has been steady buying, yeah. Well, have you seen really, really strong divergences? So the reason that the tick can be useful is it if say we're buying, but the tick is saying like plus 1,000, that can be a really strong indication that it's program buying, and that it's like you know an S&P 500 fund that's doing the buying and stuff, right? Which just means you're going to get a more consistent and strong move. I must say, now that we've moved a little bit higher on this leg, when we were kind of mean reverting, and not mean reverting, but like we made the push and then it was kind of in the pullback, it kind of felt a little wishy-washy. But now when you come over and you look at it and you come on this chart, I mean, look at the R squared is at 0.747. Okay, so like we're basically to a strong degree of autocorrelation now. We're getting a pretty strong and consistent trend here. Yeah, pretty strong and consistent trend. Oh, the ad index. Okay, that is volume wise, isn't it? That's like by volume or whatever. What do you mean by it's been a demarcation? Well, the treasury moved higher there. So the price that I picked was a bad one. But the 30 is still chilling on. Did not come back very much at all. Oh wait, is my? No. Huh. There we go. I was like, is my chart screwed up over here? Don't think it is. Curious. That was maybe a better entry right there. But isn't tick? I thought that tick was at any given time how many stocks are advancing versus declining. It's been a long time since I've looked at those. I don't remember the specifics of them all. I used add as well. For the tick, here's what you do with the tick. Put a simple moving average on it. Try it. Okay, well, the S&P 500 breaking to more new highs and possibly heading up to 4360. Maybe going to break those overnight highs. They sure look determined to get there. But the treasuries decidedly less bearish now. Don't know. An 8-tick swing back was quite a bit more than I was anticipating, I'll tell you that much. Yeah, I think tick is instantaneous, yeah. What I find so curious is how correlated the volume nodes are. Well, this is kind of one of those things about volume profile that just it really bothers me with the way that people try and analyze it, right? Because more often than not, the price that has the most volume has the most volume just because they were there for a long time. I don't think that it really represents like a value or like some sort of a fundamental call on that particular price or anything. It just happens to be where it was chilling, or that it just happens that a liquidity hole was created there. Because I really don't think that liquidity holes, unless they're somebody's trading a large meta order, liquidity holes can happen randomly, you know? So well, just a little bit further, I think that it would really need to be like hitting into 4370. But I think there could be some crazy stops up here, yeah? Well, over here in the treasuries, one has to wonder if we are turning into another, you know, the down part of the cycle. Can the 30-year really fall further? Because that last fall was pretty steep. And over here in the treasuries, high degree of autocorrelation here. How long can that last? Well, yeah, around 8:15 to 8:45 is kind of that reversion period. So we might have to sit through that. This dog, it loves me. Loves me so much. I love him so much. Hmm. That came back a little. Hmm. Yes, it's just like right on the edge there. I don't know if they're quite ready to go. Well, I'm kind of seeing some volume both ways here in the 10-year now. I'm not 100% sure where it's going to go from here. At least I seem a lot less certain now than I was 5 minutes ago. Hmm. Seems like some of those offers are a little weak, though. I'm not a fan of this. It's a little odd to me. Some of these moves, I might just be seeing things because it'll seem like the S&P 500 is making a little bit of a move up, and then the treasuries will move up a little bit. But now this move in the treasuries seems to kind of be accelerating. Don't bite that cord. It's still a big iceberg up there, huh? I don't know. I'm not sure what to think of this. I suppose that this could just be like our original theory that the treasuries are going to, geez. That came back. I'm so glad I got out of that, but geez. That maybe because of options and so forth, they're going to revert. But that was such a strong move back. I think that you're going to have to see a little bit of a pullback here. But another thought is that maybe there are some risk off headlines coming through that we're not aware of. But then why would we be seeing reactions in the treasuries and not in the ES? Look at that. Feels so behind the curve here. I don't keep the dog in that little cage all day, but he's a little dog. This is a funny thing. It's actually not a cage. It's like a big playpen. So he's got plenty of room to play around there and there if he wants. So I don't think that he feels too constrained in the playpen. But what does happen is he gets bored. Somebody has to play with him. And the kids don't play with him as much as they should. Yeah, he's whining at me. Yes, puppy. Okay. But you have to be helped because I don't want you chewing more cables. Jeez, I don't know, man. That buying in treasury looks awfully aggressive, doesn't it? Hey, don't scratch my neck. No, don't paw me. Bless you. Here. He's cute. A real man's dog. I know, right? I've basically everything in my life. My aesthetic is cute now. That's my aesthetic. You know, they have that thing on TikTok. What's your aesthetic? Aesthetic. My aesthetic is cute. Get it. You can get it. Get it. Okay, well, I don't like the way the ES is reacting here, so I am going to take one contract off. And come on, there we go. Since I really would have expected it to just blow through those targets. Yeah, I am hearing stuff from like Drogan and Putin. That I'm kind of getting the impression from the way this is moving that somebody is scared about something. But I don't have actual information. I'm just seeing order flow kind of in line with that kind of a trade. You know, we were getting really bearish action and it just flipped, like completely flipped. And we had a beeline straight to the highs for no reason. Well, it looks like they didn't bust through the open. They pulled back a little bit. They kind of a little bit of a, they fell back into the liquidity hole here. You still sneezing a bunch, huh? Yeah. Yeah, so that's the other one is why is oil so bullish today? And frankly, gold too. Gold too. What is a liquidity hole? A liquidity hole is an area of lower latent liquidity that makes it difficult for price to move out of that location. Because basically, if you get above that location, there's too many buyers. And you get below that, or sorry, there's too many sellers. You get below that, there's too many buyers, and it makes price get stuck there for a while. So you'll kind of see these. Hold on. He just wants to play. I'm going to try and give him back to mom. So when you get a liquidity hole in the treasury, it's really obvious because you'll get a price like 18.5 right here, right now, where there's less being offered at that location. It'll tick up and hardly anything is bid in that location. And then you don't really see a whole lot of volume hitting into 18 and 19. Whatever volume hits at 18 and 19 is way less than what the liquidity is there. And so it'll just rotate back and forth across that forever. So when you see it on a chart, like if we come over into the 10-year here, see these locations where it just gets stuck. And even kind of like right here. So there's kind of a little bit of a liquidity hole between 18 and 19, right? So what causes it is there will be so let me come back here. Let me show you something. I'll try and show it this way. And we'll just change the chart back later. So a little tick up there at 19. That's good. So if I come in now, look at volume. Okay. Well, here's something at 6 o'clock. I don't know about that one. But take, for instance, so here's this liquidity hole that formed right here. Look where the maximum volume happens. Right? Same here, here, here. You see it? And now here and here. So essentially what happens is a lot of people trading all at once can put enough strain on the liquidity providers in that area that they're not willing to put a whole lot of liquidity out anymore. And that makes it hard for price to move away from that location. So when we get a liquidity hole, it's kind of one of two things. One, it's either it's going to be stuck there for a while and you don't necessarily want to be in a position, or it's one of those pullbacks on a trend. So if we're going to have another leg up, like 18 is the place to take it, right? If we're going to have another leg up, but we don't 100% know why they're buying it the way that they are. So I don't know if we can make that call per se. So does that make sense? Liquidity hole, if you want to see the study, if you want to read the study where this is kind of proven mathematically, it's a search for Walrasian auctions, WALRASIN. And in the book where it trades quotes and prices, they talk about this. They don't call it a liquidity hole. A liquidity hole is my name. Okay. But so another thing that will happen though is if you move through a bunch of prices too quickly, the liquidity behind it doesn't build up very well. And it's a little deceptive because you can't just look at the resting liquidity. You can't say, oh, okay, but there's 1,400 here. Like that's just what it was on this other side. It's not quite the same thing. You're going to find that these prices, well, I mean, it's already too late. But when we had that move up to 21 and it came all the way back here to 18 really quickly, right? What happened? It was only like 200 contracts traded for it to go through there. So it was really like the buyers that came in and started providing liquidity in those locations, they weren't very dedicated, right? They didn't really want the fills. They put it out and then they said, nah, I don't want it. They just pull it, right? So it takes some time for the liquidity to heal, essentially. And so when you get a move that's too fast, you kind of get that tendency for it to get sucked back in. And that's what happened in that situation. So it's fair to say that whatever direction we break from those areas is usually a good sign of the short-term trend. Well, not necessarily, because what you can get big breakouts from those, right? So the liquidity hole, I'd have to say it's my favorite subject. I used to say that the square root law of meta order impact is my favorite subject, but I think that the liquidity hole is the one that's the most interesting to me, because when I started, I would use range charts and I would see that tendency to you'd get this range chart where it would be like this, it'd be like this, and it'd be like this forever and ever and ever and ever. And I actually did some studies and I found this one trade. That I bet you if I backtested it, it would still be good. And it was basically like, if you stay in that range for a certain number of times, and it was like, if it goes back and forth 16 times, then it's extremely likely to reverse the trend. But that was the only statistical aberration I was ever able to find out of it. So yeah, be very careful. Again, a liquidity hole is just a condition. So I don't necessarily know if we're going to go higher or lower from the liquidity hole. Right now, it looks like we're likely to go higher in the treasury. But here's the thing, and this is like so key. I don't feel like I've got the best messaging yet around this for you guys to understand this yet, but this is how I would explain it. If you have the market data and you look at it, you don't know what's going to happen next. But if you know what's going to happen next, you know what the market data is going to look like exactly. So if you know that there's a large meta order buying and you know what the liquidity conditions are, then you can very easily say, okay, there's a liquidity hole here. We're going to have a pullback. We're going to sit here for X minutes, and then we're going to have another leg higher. Right? So it's really cool, because if you have something that really is a strong predictor of the future order flow, right? You can predict, like, the prices to take, essentially. Does that make sense? It was like in this situation, it's as I said, right? Well, we moved up too fast. We came back into a liquidity hole at 18, right? So if there's another leg to the meta order, we're probably going to do this. Ta-da. You see how that's useful? And you know what I think the cool thing about it is? Like the thing that I think is so appealing about it, and I don't understand why more people aren't looking at the markets this way, is like, it's not like, okay, when you see a liquidity hole and you know that there's a meta order being executed like this, that X% of the time it happens like this, and so on and so forth. No, like, these are properties that are so insanely consistent. And I mean, they are really, truly consistent market behaviors that they, if you go and you look at a move, the amount that it moves is related to the volatility times a constant times the square root of the size of the meta order over the total volume for the day. Every time. This is an empirical result that has been found in markets over and over and over and over and over and over again. Retail traders don't know anything about it. So it's a 2-leg pullback. Yeah, it is. But like, that's again, it's kind of funny because I draw this chart on here, and your immediate thought is going to be, oh, okay, so I should look for bear trap pullbacks and trade those. Well, the bear trap pullback happens for a reason, but just seeing the bear trap in the price movement doesn't necessarily mean that it's going to continue up. If you just do that, you get what I mean? Every time that you see that thing, maybe 50% of the time it continues and 50% of the time it goes down. So you have no positive expectancy off of that, right? But if you have a large meta order of X size that will create a liquidity hole, it's going to do that every time. It's going to do that every time. So if you have a piece of information that lets you know that such a meta order is really being executed, you can play that pattern, right? In this case, I'm wondering, is there news that we don't understand or something that is going on, or is this mean reversion from the options going on in treasuries? I am kind of getting this impression from the way that the treasuries are moving that this might have just been a meta order that was going to be buying all day anyways, you know? So let's see. I am seeing a little bit of flattening coming into the 30-year, but that whole initial leg down and then reversal, I find extremely curious though. Like that seems like as a move that would be unlikely to just happen. That there would typically be some news centered around it, but I'm not really seeing the news that's making that happen. The S&P 500 is still looking pretty good, but at the moment looks like they're failing to breach the overnight high. Of course, they could very easily flip around and get it, but I think that there is a certain point at which the S&P 500 starts to fail, and maybe that accelerates the move in the treasuries. That is a possibility I'm seeing here when I kind of try and sort out the correlations. Does leverage get reduced if you go short a CME product? No, I think that the leverage that you get a long versus short is the same, except for in Bitcoin. In Bitcoin, you have to put up more margin if you're going to go short. I don't know if they still have it that way, but when they launched the product, that's what they had. What does Spot Gamma say here? What happens when you missed out on the rally you chased by going full on into TQQQ, heaviest call buying orange over the last 30 days? Interesting. Okay, so they made a good little push there, but there is still a little bit of weakness on in our bids holding us back. So, since that initial move, it's going to take, it might be a little bit longer. In fact, we might not see the next meaningful push up until after we're done streaming. So I'm gonna teach you something else, okay? I don't think I'm ever gonna make a video about this, okay? But this is really effing cool. You have a meta order, right? It goes like this. This is the impact. This is the impact. This is the number of, this is Q, okay? After Q stops, okay, the impact declines like that. So this is the post meta order regime change. So this is often what causes the liquidity hole. Can I say, if you're somebody that's executing a really large order, creating the liquidity hole is advantageous to you. Because even though you can't trade as much volume in the liquidity hole at once, it will stay there at the liquidity hole so long that you will end up trading more volume at that location. And so overall, it reduces your average price if you do it that way. Okay. So that's what happens is they want to reach their maximum impact and create the liquidity hole and then trade in that. Okay. And then there's this post meta order decay sort of a thing, right? Okay. This right here, the shape of this is it's what is this? C times omega times the square root of Q over V. Okay. This one follows a 3/4 law, so it's Q over V to the 3/4 or something like that. Okay. But here's the thing that's cool is that you can look at the time of this and you can predict what the time of this is going to be. See how that might be interesting? And there again, it's that 3/5 thing. So that initial move is going to be 3/5. Then the decay is going to be 2/5 of it. Right? So when you do the math and everything, basically you're going to be looking for 1.5 the time. So if I come over to this, the people placing those large orders aren't doing it manually. Yes and no. They are using algorithms, but it's an algorithmically assisted human trader is what it typically tends to be. So I think I have a tool here. What is it? Time extensions. So you can go from here to here. I think it is. So from here to here, what was it? It was from roughly 8 o'clock to 8:20. Okay. So then what's 3 times that? 45 minutes. So we should expect from this initial order here, 8:19, until the end of this, that we should probably see, and they're always going to modify it out a little bit, right? Because they don't want you to be able to catch this, but we should expect if there's another leg for it to happen sometime around 45 minutes from when this ended. So sometime around 11 o'clock. And that's how I try and time things. Oops. No, I did it wrong. Yeah. There we go. Have to, when I close my workspace, I have to remember to not save it. Another thing that happens as you get into this sort of thing, what? Ascending triangle, right? Whoa, what the heck? What the heck? Ascending triangle breakout. Because what can happen on that one is you had a liquidity hole, right? So they came back, but then the meta order is still executing. I haven't seen any research about this one, but I highly suspect that this ascending triangle is also a pattern that is created by this phenomenon. So that's interesting. I don't know why I felt compelled to share. I guess it's because it seems like you're getting it, you know? When I feel like you guys are getting it, then it's like, oh, I can give you more. Yeah, I'm just not sure. So, okay. So going back to, the people aren't doing it manually. So the way that works is super interesting. Super interesting, dude. It's like they'll have a DOM just like this one, But their DOM is kind of special. It'll put like orders at every price. It'll put orders at like every price. And then there's all sorts of things you can do. Like for instance, there's just these algorithms that will come in that will just buy at certain intervals. But I saw them doing it as like there was multiple people and there were certain people that were supposed to be absorbing contracts. And then there was another person that was controlling the inside bid and offer. They were placing a certain amount of liquidity out there and stacking and pulling that liquidity to keep price within their range while they were acquiring the contracts. And then when they were done, when they were ready for it to move, cancel these orders, buy everybody out, place a bid. And they do that on, and it would move. Bearish is not unique. Okay, so by the way, that move that we just had below the 43.50 in ES does appear to have breached the average true range stop, which kind of means that generally all of the retail traders will have been stopped out by that point. I don't know if that means that we're going to have another move higher or not. Just kind of an interesting point that tends to come through over and over again. So I'm kind of like looking at this and it seems like there could be more to these moves today, both in the ES and the Treasury, but they will probably resolve themselves after I am gone, unfortunately. Well, okay, that offer at 21.5 looks pretty scared, doesn't it? Oh, okay, he chilled out. There's a big offer got stacked on the 5-year there. Sounds like manipulation to me. Well, okay. I would be really careful with the words you choose, right? So, from a regulatory standpoint, manipulation means sharing information that you know to be materially false in order to try and influence people to buy or sell a security. That's what manipulation is from the law, from the perspective of the law. Okay. If you go and you submit orders and those orders have a tendency to move the market up or move the market down, that's not manipulation. That's called trading. It's called trading. And like, here's the thing. Why are they doing all of this? They have to buy something. Maybe it's because it's a hedge fund and they really want to buy the treasuries, but it's probably more likely a sovereign wealth fund that are just doing their thing. Maybe their country needs money. Maybe like the reason that they could be doing it could have no information behind it at all is the point to that, right? They're just doing it, but it's going to move the markets. So if you're buying it here, you want the price to move as little as possible, really. I mean, like from the retail trader perspective, because you're probably thinking of it like this. You're probably thinking, well, yeah, if I buy it up in here, then everybody else keeps buying it, and then I can sell it on them, and then I can make money, right? Well, unfortunately, it doesn't work that way. Why? Because of the liquidity hole, remember? You got this. So, and then there's less liquidity behind us. So if you come in and you immediately try and sell that whole position, you're going to do that. You lose money. So these guys, they're trying to execute as efficiently as possible, because if they move it too much, then that's just going to make it the fall harder, essentially, right? So you want to buy as low of a price as possible. So it seems like manipulation to us, but in reality, it's just them doing the best with the hand that they've been dealt, because this is the disadvantage of what they do, right? So their orders have a really significant impact on the market. Whereas you and I, if we know that that meta order is coming in, we can come in and start buying it like as soon as we see it and front run the whole thing and make money because our order hardly has any impact at all, right? If you know the information is coming. But that's where it's kind of like, so you should watch the volume. You should come in and say, if I think a meta order is going to come in, how much volume is going to do? Well, we bought 15,000 contracts here today. Do you think that there's going to be 30,000 contracts? It's possible in this situation. It's possible. Okay. Same with like your technical signals. Is like how many people are actually trading that technical signal? Because now all of a sudden the all of you combined are kind of like one of these guys, and then you have the same problems. And if you're not in early enough of that, then you're not going to make money, right? Good calls today, very educational. Thank you. Well, I mean, I didn't make a very good call on which direction the treasury was going, though, in the end. I mean, once we started to get this trend, but like what you're seeing right now is kind of this other problem of like only relying on the market data, right? Like we got to a point where we could see that there was some sort of large meta order being executed, and we tried to trade to it. And then what happened? Well, I was a little bit early, but now we're stuck in the hole. And that's usually what happens is like by the time you're certain, the liquidity hole forms and then it doesn't go anywhere. You get stuck. And we don't know if there's another leg, right? So it's very much a gamble on my part. It would have been much better if we had known way back when we were at the highs over here that this meta order was going to come through and we could be up $30 right now, right? At the moment, it kind of still appears that the liquidity is not fully healed. And in fact, we may even be starting to see people trying to trade it the other way. So we kind of got to be on our toes. Well, okay, they're willing to buy 1,900. Patrick Rooney, what do you think? Will we see 3K Ethereum in a week? Ethereum 3000 calls that expire on March 25th have been popular this morning. Well, that's interesting. That is very interesting, actually. Where is Ethereum right now? 2807? This is very possible. I kind of think that Bitcoin might be due for another little bit of a drop, but I don't actually see any real specific reason why that might actually happen. I think that that's just kind of wishful thinking on my part. So Ethereum 3000 might actually happen. But here again, you'll be really careful reading the market data and making some assumption that these guys that are buying the Ethereum calls, they know that it's going to go there or something like that. So the market's not informationally efficient. Okay. So I just heard I didn't hear what he said per se, but it sounded like it was related to Ukraine, and the S&P 500 is cratering here. Is just cratering here. I did see a little bit of upside pressure in the treasuries when that happened, although it's not nearly as strong as I would think that we should see if something's really falling apart over here. But maybe some more tea leaves that there is a developing news story that hasn't really truly hit the broader market yet. The dollar. Why do I have it like this, by the way? Yeah, see the dollar reversing really hard here too. Okay. Western official, there's a significant difference in positions in the Ukraine-Russia peace talks. If that was the piece of news that moved them, I'm a little surprised that that moves them as much as possible, because we don't know who that official is. So that might just be algorithms trying to trade and react to it. Yeah, if we get down to the bottom, so I can give you price levels actually. Well, we already touched it. We already did it. I don't know. I actually think that most of the selling that you get from people's positioning has already unwound actually TLA. Unfortunately. If we break the lows, I think that people might open new short positions, but from my metrics, it looks like that the existing positioning has already unwound. And you will see this, dude. Look at this. This is insane. I don't know how to prove this. I feel a little bit like I don't want to like market this as like, dude, this totally works. It's a proven thing, yada 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 yada. It's just we built this model and we've been observing it, okay? And this right here happens every time. Almost every time that we have a big move, Russia not acting like it wants to settle, Pentagon aid says. Yeah, that sounds like that's the same story. But we don't know who that Western official is. Okay, but no, you see my little dotted blue line? When we have a full stop out, it'll come down to that blue line like every effing time. Every time. I can't predict when it's going to do that, when that's going to happen, but it will go to that line every freaking time. And so I think that using this model as a kind of an estimation of where market maker positioning and stops and everything are, it seems to have some efficacy. This model, if we can figure out how to use it right, because I don't know how you build a trade off of it, we can figure out how to use it right. This is very valuable. This is why, my indicator package that you download at Speculator Seth is worth $100. Otherwise, I might have made it free. But that's why I'm saying I think that the most of the positioning already unwound on that move. Well, the treasuries are still kind of pressing the top there, but it's not, they're not trading like super urgent or anything. Could see the 30 years start to do some interesting things here, because the 10-year and the 5-year have just kind of been riding the line. Now the 30-year is like smashing into it. So if the 30-year decides to take another leg up here, then we could be looking at a situation where the treasuries really run again. I think that in order to justify a move like that, we would really need to have like a real headline. The market is reacting to this headline like that, but when I read the headline, I'm a little bit like, really, that's what they're moving on? I mean, yeah, it's bad, but he's telling us something that we've known for like 3 days now. Maybe not everybody in the market has been paying attention and believes it, but I don't know. What else can you say? The market does appear to be reacting to the headline for sure, doesn't it? Now on my side, I'm not unprofitable on my ES trade until like what? Well below the lows. Yeah, but you know what? Given the time frame and everything, I am going to take my $200. I thought that I played that in the ES. Well, I think that maybe I should have been using that ATR stop. Like maybe when that ATR stop had gotten triggered, I should have said, let's get out of that ES one. Yeah, let's get out of it. But the big question remains still in the treasuries. If we're getting a large meta order buying, why? And how much more volume is there to come in? Is the large meta order buying because of these headlines that we're getting now? Were they doing this from the beginning because of that? Or is this in addition to it? Because if this is in addition to it, then that's again where you could get like some really crazy upside movement in the treasuries after they continue to break highs, right? Right? But you know what? Today was a really good session, guys. I enjoyed talking. Sometimes I'll have these sessions where I feel like I'm not getting through. Today I felt good about this. I guess the problem is that for most people, just showing you the math and the evidence isn't enough for you. But when you're sitting here and you're trading it, and I'm able to tell you like exactly what's going to happen, then all of a sudden it's like, oh, maybe this is for real, right? Hey, I will see you guys tomorrow, Friday. Friday should be an interesting day, that triple witcher, right? In the meantime, though, stay profitable, friends.